Sound and screen are great. Good. Toll Brothers, what I was just saying is Toll Brothers gave us a couple of gaps. I don't like when we have a gap up, close down, or gap down, close up, meaning gap one direction and move the other way to close the day. So as we're looking at this, yeah, we're back. Me again. We're doing earnings. So what I was saying, I got the schedule. I looked at the schedule, and then I looked at my timer on the recording and saw it had gone past an hour. And then so I looked at the other clock, and it was at the top of the hour, and think, oh, I got to get off and let the professor on. But what it came down to is you still get a half hour of me. You lucky people. So that gives us enough time to go through earnings. What changed my mind? Actually reading the schedule. That's what changed my mind. Reading the schedule changed my mind. So a gap down, close down, and a gap down, close down is a strong indication that we are pricing in weakness. We're saying we're going lower and lower. If it was a gap up, close down, it was trying to be bullish and had to unwind it. A gap down, close up is trying to be bearish and unwind it. And so when we're looking at those moves, this seems to support the idea that we should be liquidating. So if we're going to measure this, and we're going to go from this, normally we'd go from the open to the close. When we have a gap prior to that, we could even go to the close of day 0, because we did the 2 days before, so 2 days before, but close of day 0 all the way down. So theoretically, Toll Brothers, if we could price it right for a directional trade, we might sell the 104 call vertical and buy a calendar or a diagonal all the way down near 98. If we don't want to include that, we actually still have a directional trade currently from day 1 open to day 2 close. So Toll Brothers is saying, yeah, you've got about $1.50 in here that we could sell a vertical up here and buy down near 99. If it closes higher, so this is my warning to you. If it closes higher, it will do 2 things. It will be a measurement of a gap down, close up, which is a warning. Let me see if I can refresh here, Vicky. Yeah, so we've got some of these muted. They're muted when you when we do the one candle reversal. I can take the one candle reversal off, and it'll make them bright for you. Let me do that and see if that makes it easier to see, Captain Vicky. Good to see you. Seems like I haven't seen you for a while. I miss you. Let's go through here, and we're just going to get rid of this study. It'll make them a little brighter. Is that better? So as we're looking at the difference here, the up to the down, just remember that if this closes up, if today's candle ends up closing up, then I have a gap down, close up. To me, that's a warning that they're having a hard time pricing it. But if we stay lower, then we have a directional trade. We could go 102.50 for the short vertical and target at 99. Let's check our implied volatility, and let's run the numbers. Toll Brothers, front week, 75. Next week, 51. Half of 51 is 25. And 25 plus 50 is 75. So we're actually just a tiny bit below where we should be to make this work, which may mean that we can't do a directional trade. We might have to do a calendar, a double calendar, since we're right on the edge. But let's run the numbers. We don't know. We do not know yet. I am reticent. All right, let's take a look. If we do a directional trade, looking at the chart back here, we want to sell the open here at 102.50. Is there a 102.50? There is not. So we go to the next one. And let's change this to delta, gamma, theta, vega. I wouldn't want to sell the 102 because I don't sell deltas above 42. So we go to the 103. If I sell the 103, it's got a delta of 40. This could work. I'd sell the 103, buy the 104.50, as long as I get 25 cents per dollar wide spread, which in this case is 40 cents. Good. Everything's working so far. We're targeting, this is a reminder, we're targeting the 99.36. So that means we want to sell or buy a calendar using the front month with a higher volatility, collecting 75 implied volatility, and paying hopefully 50 implied volatility. So the directional earning strategy says sell the vertical, buy the calendar. It tells us that we have a 15-cent debit. Mike says, facts. What changed my mind? Facts. Facts changed your mind? How un-American. I'm gonna take a quick side tangential comment here. That comment years ago. I'm a very moderate politician or politically viewed person, not politician. I'm not a politician. A very moderate. I'm a moderate, slightly conservative-leaning moderate. And so there's one point that I said, you know what? I'm kind of liking this name withheld senator. And my mother-in-law said, what? I thought you didn't like that person. What? Why didn't you tell us? I said, tell you that I changed my mind about a senator? And I said, I also didn't like the Porsche Cayenne when it came out, but I really like it now. Am I supposed to report all of my views changing? Because, like you said, it's very un-American to change my opinion, apparently. I should set my opinion once and not let any other data come in. Anyway. So here we go. $1 plus 15 cents debit means we have a max risk of 115. We go analyze the trade, and we have to go to the risk profile, not on the fundamentals. And we're going to look at this as a earnings play. You can see this mountain. We're going to climb the mountain and hopefully get paid a lot. Now, the maximum we could get paid is this peak. The peak is all the way up there, about 259. I'm looking down in this corner. I actually had someone remind me that they didn't know where we were looking. And that bottom left corner will show you over here what you'll make. Blue line is at expiration. Purple line is today. So if price moved up here, none of the volatility is being crushed out, you're really not going to make anything. You can see it drop all the way down to your peak target, and you're going to be up 14 bucks. Okay? So the risk is $113. We're going to set slices to break even. And I know you can't see that because it's off the screen, but I'm setting slices to break even. It says you have a 73% chance of not losing. We haven't crushed out the volatility yet. We're going to get rid of the volatility in the front week to match the second week, and we're going to take the second week and match the stock. And we'll do the same thing with a non-directional trade as well. 76 down to 52 is 26. 75, we'll do the same thing. I'm just going to drop them all 26 rather than getting too particular. And we're bringing them all down to 50. So theoretically tomorrow, after earnings, when the volatility crushes out to 50 in the front week, and the back week goes from 51 to 41, we see that drop 10% and match the stock. Theoretically, this is what we're looking at. So we'll move it forward one day. So tomorrow, after all the noise, after all the excitement of whatever they said, and everything calms down, we're still risking the 113 as the max loss. That does not change anything. But it does change what our peak return can get if the volatility crashes out on the back week. This is what we're going to look to make in the front week, meaning by Friday. And we want to be out of this by Thursday. So as long as we're looking at this and we're looking at a peak here at 200, would you risk $113 to make 200? Well, sure. I'm okay with that. But we're not going to hit the peak. So I always like to take that peak value, 206, 208, somewhere in there, and cut it in half. So would you risk $113 to make $100? And if we're talking about $113 risk to make $100, you have to be right just a little bit over 50% of the time. This says we're going to be right about 3 times more than we're going to be wrong. Not at the 50% level, but we're going to be right 3 times more than we're going to be wrong. If I add in another strike, let's go ahead and do that really quick, and I'll clear out all those lines. If I add in a couple other slices, 1, 2, and say, what's our chance of being in this $100 range or more? we start taking the picture saying we're going to lose 23% of the time, but that's not even max loss. Realistically, if we're going to add max loss in there, and we'll just bring it over here, lose $100 or more 5% of the times. Lose something between $0 and $100 18% of the time. Win $100 or more 50% of the time. So actually, I have a 10 times potential of winning $100 versus losing more than $100 as far as probabilities are concerned. I have a 2 times, 3 times almost, of losing anything to winning that same $100 or more. And these 17 and 9 are making a little bit, something between 0 and 100. So I just see this as these numbers, the ones that are making somewhere between 0 and $100, the 9 and the 17, so 26, is more than offsetting the 18% probability of losing the same. So I just say, let's ignore all that and say, would you risk $113 if you're going to be wrong 5% of the time, if you could make $100 if you're going to be right 50% of the time? And everything else is kind of a wash. I'd say yeah. Let's do a non-directional trade as well. Yeah, you're right. Opinions do not matter, but being open to new data does matter. Right, Peter? Robert says, as long as you do nothing for the good of the country, then you have both sides. There you go. I'm beginning to feel like a mouse. The cat trade is bouncing around the $3 close price over and over again, but won't fill. Yeah, keep working that order and adjust it. Harold, I found that I can get fills that way if I resend them. Change it 1 penny better for you. Send it, then change it back to what you're trying to get, and send it again. See if you can get that fill. I've had them a couple of times. It's just like they forgot I was there, but resending it, I've actually been able to work it and get the order filled. And then I also say, well, let's go for $2.99. Let's go to $3.01. Let's go to $2.98. Because if the end it's $3 price per contract, if I have to give up $1 in the end to get a fill, but just work it. Don't give them everything. Don't give them the farm. Let's do the non-directional trade for Toll Brothers really quick, and then we'll go look at some others. Yeah, or even, as Kenman says, even resend at the same price. Wake up, remind them that your order's there. Wave your hands above your head. Look at me, look at me. All right, because we have this implied volatility, we can try to do a non-directional trade. The non-directional trade, generally, I'll try to buy the back wick near 25, and I'm going to buy that 96 and sell the 96. We're going to do the same thing for the double calendar over here, and we're going to look for the 25. I need a couple extra strikes to be able to see it even. Let's just go with 15. And we're going to buy the 108 and sell the 108. 85 cents. Analyze this trade. Hide the first one. We still have some vol crush that we have at the bottom of the page, but these are different strikes than what we had, so we'll have to readjust. So if we were just playing this and there's 0 volatility crush, we'd have a 99% chance of not losing. That's not reality. If I told you had a 99% chance of not losing, 99.75, you have a 0.25% chance of losing, we would all take this trade over and over and over again, especially when there's a chance to make $200 and 0.25% chance of losing. But that's not reality. This vol crush is going to kick in, and it's going to change the scene here. So let's put the same thing that we did before. We're going to take the 77 or 75 and drop it down to the 51. So 75 to 51 is 24, and 74 to 49 is 25. Crushing out that volatility. And then the 51 to 50, we're still going to bring down to 41. We're going to match it to the stock. And I'm just going to do -10 and -10 just for speed and convenience. Now, our circus tent collapses and touches here. It doesn't quite go negative, but it touches there. And so reality is we're not looking to make $200, one. And number two, we're not going to make $200 for everything in between. what we're doing now is we're seeing that the break even are going to move in only a little bit, but all of this is kind of nothing, right? So we're looking at saying risking $85. What's our chance of hitting this peak? Pretty slim. What's the chance of hitting in here? Better than hitting the peak because it's a rounded, bigger base here at the bottom. So if we were to add a couple of slices in there, and we were to say, what's our chance of not losing and winning, but what's our chance of making at least $50 and getting enough return for the risk that we're placing on this chart? And so we're going to go from the $50, moving it over, and saying, okay, $85 risk for $50 or more. Could go as high as $150 if we nailed it perfectly. But we're just going to say $50 or more. Would you risk $85 to make $50 or more? So let's do the same thing we just did. Yeah, if those numbers really were real, WW, yeah, bet the farm, right? Lean into that. If you had a 99.97%, but that's not reality. We have to crush out the volatility. There's a 64% chance that you're going to win $50. Would you risk $85 to make 65 with the 64%? I'd say, yeah, maybe. I think that's a reasonable number. We could run the numbers, but we want to say, what's our chance of making over 50? And we're going to also turn this into a double calendar here in just a second. Okay, and let's also not forget, when I'm going out to delta of 25, we already can see the market makers are pricing in a $5.7 move. So if we're talking roughly $6 move and we're currently trading at 101.50, we said, well, it should go to 107.50. That's why Tim's saying we could go to 106. But that's the probability of touching more than anything. Its expected move is a touch, not necessarily a close past. And we're talking about if we hold this to Friday and the volatility crashes out, or Thursday and the volatility crashes out, would that be a reasonable trade to take? If the volatility crashes down, would you risk $85 if that meant you're going to lose $85 1% of the time? If we're looking at winning and it's less than 50, so we'll just call this $25, $20 64% of the time, and you're going to be risking 85 if you're just playing for it to stay in the middle. Would you do that? If it was 80 versus 20, it was reversed reward risk, 1 to 4. That means you have to be right 80% of the time, or maybe better said, you have to be right 4 times more than you're wrong. Well, if you're only going to be wrong 1%, 4 times, we say you only have to be right 4%. This says we're going to be right 64%. If it's accurate. And you have to assume that you're not going to move for that to be the case. So if we're talking about a $6 move, 101 up to 107 means that we're going to be somewhere in here. 101 minus $6 move would bring us down to about 95, so somewhere in here. So both of those are saying, would you do it for $50? Would you risk $85 for $50 for the fact that you're not going to go 3 standard deviations out? It could still. It could. Absolutely. Move more than 2 standard deviations. But as Timothy's pointing out in the chat, Toll Brothers over the past 2 years has not moved more than $5 after earnings. They're pricing in 7, and it hasn't moved more than 5. So this could be a beautiful sweet spot hitting this $50, $100, even $150 return up here. I'm looking at this saying, based off the way the market is pricing it, it looks like it wants to go this way. Chris asks if the constant search for trade ever get tiring. I spend most of my trading day trading the currencies and the futures, index futures. So really I've got, and when I say that, I also do some gold and some crude. So most of the time most of my time and effort is spent on 10 instruments. And that's it. And these are just earning strategies. Do you want to collect some premium from volatility on a singular event? And I think this one works. You say you like the bigger strike, the bigger move out. Or sorry, the lower one, getting it a little tighter. See what that one does. 107. Tim says let's move that in. It increases your cost to 93 cents from 85 to 93. We'll still bring the volatility down to 51. And we'll still bring that back week down. So it gives you more space here. Yeah, I like that one. I actually like that one better. I'd rather pay a little bit more where we're expecting it to be in this area. That could work. Gives a little bit more, the target's going to be a little bit more precise. So one is going to, this is the double diagonal. Let me just copy this and paste it. This is, and we have to wait towards closer to the end of the day. Double calendar. And then I'll copy the other one. Directional. But wait until the last hour if you are considering the directional. Because if it closes up, you're going to want to be in that diagonal or double calendar anyway. So that's the one. Yeah, no. And I would say, you know, Chris brings up an interesting point. He said, you know, it wasn't a question about anyone's specific trading style in particular, but something that keeps popping in my head now and then as I search for stuff. And that's there's a hierarchy. So there's different kind of trading. If I'm watching for a major shift in the economy, like what we're seeing with Visa and MasterCard today, then I would say, hey, we're seeing a change from consumer discretionary to consumer staples. This is probably when I want to be paying attention to something that is altering in a macro scale. And I might be able to find some really significant changes that are going to give me a long-term opportunity. The other thing is measuring out the distance, you know, the volatility like on a singular event. It's not taking me a lot of time. Top-down analysis, I'm looking for the big stuff. Individual earnings, I'm just looking at that and saying, yeah, I'm not really picking apart anything. I'm just saying, hey, where are we at? And what's the calendar show? That's it. And then as far as daily, it's just the stuff that I know that I can look at consistently with really low cost to trade, which would be futures and currencies in the intraday or even multiple hours, but not necessarily always just the scalping off the tick charts, but those are very consistent. So you're right. I don't have, most of the time I'm not burning a lot of energy trying to find something to trade. I know what I'm going to trade. And I think having a list of 10 to 20 things and that's it, but being open to something that is a large component move like what we may be seeing as a reversal from consumer discretionary into consumer staples as a sign of the economy slowing down, as what we're seeing in disinflation and deflation in the global stage. Now, guess what? Now is when we're going to wrap up. Now is when we're going to end. Now is when I'm going to tell you once again what the professor's subject is. So this ties in really well with what the professor's doing. And I know he set this up last week, but we're now seeing the signs of the clues that we are possibly creating the Twin Peaks. So again, the professor's follow-up, Part 2, Mountain of Evidence, introducing the Twin Peaks Strategy Part 2, will be coming up next. And yes, tomorrow will be easier. we will not let the chaos ensue. Don can sleep in on his cruise or sit in his lounger and have people bring him pina coladas or whatever he likes. So, all right. There are a couple of other earnings to be paying attention to. You might want to run the numbers on. We already did the Toll Brothers. Just as a reminder, you have tomorrow morning. Well, tonight you have Palo Alto. That one's a hit or miss, but Nvidia is the big one. Nvidia is already pricing in a significant slowdown, so pay attention. Nvidia is coming up tomorrow, and we should be very aware of Nvidia's response to the projected or the guidance. So that's a hot. I'm not willing to trade earnings on Nvidia. The cost is, it's just a little too sketchy for me. So we could run the numbers, but we'll let it go there. So the professor's coming on in about 30 seconds. Have a great day, everybody. We'll do it all again tomorrow.